Want to stop China from manipulating the yuan and the dollar? Bar it from buying treasuries, Mr. President. Hello, this is Robert Romano, Vice President of Public Policy with Americans for Limited Government, dailytorch.com. Hit that subscribe button. Today we're going to be talking about China again. The Treasury has gone ahead and declared that China is a currency manipulator under federal law. That means that they keep the value of the yuan artificially low vis-a-vis the dollar. They've been doing this for many, many years. In 1992 and 1993 and 1994, they were labeled the currency manipulator because of these valuations. And what it does is it boosts exports. So if you keep your currency artificially devalued, it'll make your exports cheaper to countries that you export goods to. And this will have the impact of boosting exports, boosting employment, boosting growth. It'll make imports more expensive, and so therefore will also incentivize domestic consumption of domestically produced goods. And so it's considered a non-tariff barrier to trade, and it's something that the president has been attempting to deal with other countries. So, for example, the USMCA, Mexico, Canada, America new trade agreement that's going to replace NAFTA has provisions in it for currency so that you could deem that currency devaluations are an unfair trade practice, and it would create a resolution if that's the case within the confines of the trade agreement. The World Trade Organization does not regulate as a condition for membership currency valuations, and so it's not something that's considered as a non-tariff barrier, but it ought to be because it's absolutely used in that regard, and the Treasury has finally made that determination. That on the basis of valuations, that China is absolutely a currency manipulator. As soon as President Trump was instituting a new round of tariffs, then the Chinese were coming in and saying, no, you can't do that. We're going to devalue our currency again. And if you look at the past year, that since May, when Trump started instituting the new tariffs, China has absolutely devalued. It was at 6.67 yuan per dollar. Now it's at 7.05. And so it's almost a 5% devaluation by China. Now, the other way countries tend to keep their currencies artificially devalued is by stockpiling U.S. dollar-denominated assets, like U.S. treasuries. China is the largest holder of treasuries in the world at 1.1 trillion. And so this is another way that exporting countries will try to keep on boosting exports and without using artificial pegs. So like South Korea does this. Other countries do this. They will basically stockpile treasuries. When they have surpluses, they get a bunch of dollars. So they say, well, let's not just hold on to dollars. Let's invest them in something that's going to earn interest, and so they'll buy treasuries. But the effect is that this also weakens currency. So here's an idea: if you're labeled to buy treasury as a currency manipulator, maybe they should lose access to U.S. treasury markets as a penalty, so that we're not going to allow them to go ahead and stockpile treasuries and do further devaluations. I think that's something that we ought to be looking at. President Trump is definitely paying attention and working with the Treasury in this regard. And he may be running out of time. Some of the signals that you pay attention to in the U.S. economy that might signal a recession are starting to go off. The 10-year, 2-year spread, this is the difference between the 10-year Treasury and the 2-year Treasury, seems like it's about to invert. If you look at just the past month alone, it's going down to practically near zero here. It's at 0.11 positive spread right now. And you typically don't see recessions without this inverting. I think that it's likely to invert soon, but maybe it can be forestalled, maybe it can't. But if a recession's right around the corner, let's say that it was, then President Trump could be running out of time. While the incumbents tend to win re-election in American politics more than half the time, if they're running for re-election, that's by no means guaranteed. And we average a recession about once every 5.3 years. And according to Bureau of Economic Analysis data, if you go in the post-war era, it's every 5.3 years on average, and it's been 10 years since the last recession. So are we going to see another recession? Possibly. The effective federal funds rate now is starting to be cut. by the Federal Reserve. They've gone into the rate cutting scenario, and that usually precedes recessions. And if the 10-year, 2-year happens to invert, that would most certainly be a signal. We haven't had a recession in modern history without that inversion occurring. And so President Trump, he might not be guaranteed re-election in 2020. And so whatever he intended to do with China, reversing globalization, this is his moment now to succeed or to fail. And so one key indicator is the federal funds rate set by the Federal Reserve. This was kept at near zero levels for most of the Obama administration. In 2016, they hiked it up a little. And then after the election of 2016, then they started going on an aggressive rate hiking scenario. In just the past 5 years, if we go look here, you can see it much more closely. Starting in 2017 is when it really started going upwards, and here we are now. Now they're going to start. Now they've said we're going to start cutting, and that usually precedes the recession. If the economy is softening, they're going to want to do that. And so President Trump, now is the time to act. If you want to take on China on treasuries, this might actually prevent them from devaluing the currency. It would give the tariffs that are being put into place some real teeth. So that countries that are currency manipulators, there should be a deterrent against that. Merely designating them as such is interesting, but if there's no penalty for doing so, it's clearly there's the tariffs. But if they can just negate the tariffs by going ahead and saying we're just going to do more devaluation, I think that that's a problem. We need to pay attention to that. We need to prevent them from being able to offset tariffs with devaluations. And restricting access to U.S. Treasury markets, this may be the way to do that. It's certainly never been attempted before, so I think that it's something that should be considered in the toolbox of the Treasury, and hopefully can achieve some resolution. Right now, the economy is still strong, so the case for acting is that we're in a strong position to do so right now. Unemployment is very, very low. We're at close to 50-year lows in that regard at 3.7%. We're in a good situation right now. And the economy is still growing. It came in at 2.1% in the second quarter, 3.1% in the first quarter. 2018 was the strongest year for growth since 2005. And the economy's been definitely slowing since China entered the WTO in 2000. It's not grown above, the U.S. economy is not grown above 4% since 2000, not above 3% since 2005. Labor participation amongst working age adults, we've covered this over the past week, has been declining. It's rebounding during the Trump administration, thank goodness, and we attribute that, Americans for Limited Government, to President Trump's tax cuts, his deregulation, and his emphasis on trade policy and trying to get better trade deals and bringing China to the table here. So if China holds 1.1 trillion of treasuries, they could go after that. And China might want to respond. They'll say, "Oh, we'll dump the treasuries." Well, that would just hasten the yuan's appreciation. So I think that there's often, and I've done this analysis in the past. Well, what if China and a bunch of other countries started dumping their treasuries? If everyone started doing it, you could have a sovereign debt crisis. Interest rates could go really, really high. We might not be able to meet our obligations and could result in default. If China were excluded from treasury markets, or if they said that they were going to start dumping them, other actors, financial institutions, central banks, they would step in and they would buy those bonds. You could even see a market panic like you're seeing right now, because we don't have a resolution to these trade issues of 10-year treasuries, for example, downward. When there's a panic, the U.S. and China might not reach a trade deal. What do people do? They buy treasuries. And so whatever China might do to dump treasuries, that could cause a panic. And then what are institutions going to do? They're going to buy treasuries to mitigate risk because equities might take a downturn, etc. So China threatening to dump their treasuries, I don't think it's much of a threat at all in hindsight and in a fuller analysis. And so barring them from buying treasuries could be actually an effective tool that Treasury and the president should be considering utilizing. We can see what happens to Treasury rates. I don't think we have to worry about default or anything like that. We have more than enough willing buyers and of U.S. Treasuries, and if China were excluded, it wouldn't hurt us in the long run. I think we'll be fine. And so I'll leave you with the close here because I think that this is something they ought to be considering. Barring China from treasuries markets might not be able to forestall another recession, and so the rationale for doing so has to be long-term. Kicking the currency manipulator China out of treasuries market as a penalty could help the U.S. achieve an implied aim of the Trump administration to decouple from the Chinese economy, or finally force China to the table to craft a long-desired trade deal, make its foreign exchange operations transparent, and let the yuan float once and for all. And other countries that are going to do currency manipulation, they'll think twice about it, because they're going to get in trouble. They could be kicked out of treasuries markets too. So if the end result of trade enforcement is that China comes to the table, you get a trade agreement, and the yuan floats, and then we have floating exchange rates and balance of payments adjustments. Would that be such a bad thing? That's the commentary. This is Robert Romano, Vice President of Public Policy with Americans for Limited Government, dailytorch.com. Hit that subscribe button, ring the bell for notifications, and have a good day.